Hello, and welcome to this week's Profit Maximizer Moment. This show is dedicated to helping business owners dramatically improve their bottom line with our weekly profit maximizing tips that you can use now. I'm your host and coach, Wayne Bilal. I'm also the founder of a local CPA firm that works with businesses to help them make more money and keep more of it from the IRS. I do this with our profit coaching programs and with our tax planning systems that has saved my clients over $7 million over the last 6 years, all legally. 5 years, 6 years, I've lost track. I love my clients, but I don't want to share a jail cell with them, as I say every week. Look, by the way, we're heading into tax planning season. We should be starting now as opposed to waiting till the end of the year. So if you think you paid more taxes than you should, give us a call. Do a free analysis, let you know whether we think we can save you money or not. Today's video, we're going to talk about KPIs, early warnings. I call it the early warning satellites for whether your business is struggling or not. We'll get into that in a minute. But first, support for today's show is brought to you by Profit Maximizing Publishing, which published my book, The 90-Day Profit Reset, which shows you how to gain your independence from reduced cash flow, shrinking margins, and an evaporating customer base. In this book, you will find chapter after chapter and idea after idea about how you can turn around your business, reset your profits from red to black in 90 days or fewer. Even entrepreneurs who are making money will benefit from this book. Trust me, there's a lot of good information in there. So what's a KPI? Well, let's talk about that. Look, one of the things that always amazes me is running into a business that makes $500,000, $1 million. I've seen it 5 million, and they have no idea what they're making. They don't have financial statements. They have to wait till the end of the month to see where they're at. If they're organized, or the end of the quarter, or the end of the 6 months, or the end of the year, or worse, 6 months, 8 months after the year end when I get around to doing the tax return because they finally brought in the stuff. All right. Um, the problem with that is that's just not an option if you're going to if you're really going to focus, like we've been talking about for the last couple months, about increasing your gross profits, okay, keeping your gross margins high, all right, because those are made up of many factors and all of them are subject to change almost immediately. We're seeing it right now with price increases from our suppliers, employee wages going up, people, customers being squeezed, having to spend more on groceries and gas, fuel, they may not be able to buy. Excuse me. So more than any time, we need to have our KPIs and know what we're doing. Okay, your customers, like I said, may have switched their buying patterns, switched to buying products with a lower profit margin. Your suppliers have increased price. Your sales staff may hit their sales bonus goals by increasing discounts, but no matter the reason, the faster you discover that your gross margins are going down, the better you can do something about it. All right. Smart business owners do this by getting daily or at least weekly KPI reports. KPI stands for Key Performance Indicators. Okay, remember that. These are quick snapshots of reasonably easy to measure items and reasonably easy to accumulate accurately that indicate the status of an important part of the business's operation. Since a KPI is designed to give an early warning to changes of gross margin, you must first calculate some benchmarks. So where do we start? Okay, here's some common ones that are out there: product mix percentages by major category, gross margins by major category or by top selling products, average price that you sold the top selling products. Remember the old 80-20 rule. Concentrate on your big ones. Average cost of major products purchased, average discount for major products sold, total labor hours to produce and deliver major products, percentage of return products by major product category, percentage of customer mistakes by major product category. This is just an example. All right. You can come up with something simple like car sales. The most successful ones will literally track how many people came in to test drive, how many people walked in to test drive. Of those that test drived, how many got a proposal? Of those that got a proposal, how many closed? Of those that closed, how many bought the extended warranty? Of those that, and so on and so on. They literally mark each one and keep track of it. Once you've determined the KPIs you should track, the next step is to set up your accounting program or your accounting department to provide you with only the numbers that you need in a simple and condensed form as possible. When I was at Coca-Cola, we had what was called the daily report, which put in those type of KPIs so that the managers could see what was happening daily. And also some things that were on there, they could see AR aging, how fast it was changing. All right. We also put sales versus this month to date sales versus this month's budget and how far off they were. You don't need to be an accountant for this, but you must know how to use the numbers. The technical part of getting the numbers to you can be left to the accountants. This is so important. It is well worth hiring an accountant or a CPA with experience designing specific custom KPIs for you. Remember, the goal is to notice trends that are reducing margins early and to act to correct the problem before you had a bad quarter or a bad year. All right. Not sure why that's coming. I grabbed something I shouldn't have. Anyways, that's what KPIs are. This one's going to be a shorter one than normal because really not much to show, but this doesn't mean that it's not important. This is the difference between reacting and being proactive. All right. I'll give you an example. I had a client that had lost a major customer. Now they do $4 million worth of sales, so it really didn't show up right away. It didn't come to their attention. But as soon as they saw this major category where sales were dropping, they were able to investigate, and they found out that the customer had, the person that was in charge of purchasing or buying from them, had quit, and the new person came in and was sending it to their friends. They were able to step in and go to the owner of the business again and resell, explain why what they were doing was important, and save that customer. Now, was that a big deal? Yeah, it was about $400,000 or $500,000 in sales, 250,000, roughly 200 to 250,000 in gross profit, if not more. So yeah, it was major. But if they had waited till the end of the year, they may not have noticed, or it may have taken them 6 months to notice, in which case they would have lost half of that, or may not have been able to get the customer back. They were able to step in very quickly and solve the problem. That's just one example. All right, KPIs are the difference between being an on-hands manager without being buried in detail, and those that just wait for the accountant, tax person, CPA to say, here's what you made last month. You need to get into your numbers. All right. Hey, this is Wayne Blau saying until next time, let's make this our most profitable year ever. Thank you very much. And let's end the broadcast. Have a great one. Bye.